This program is brought to you by IG. Trade over 12,000 shares and ETFs, including major tech giants with extended hours on an award-winning platform. IG, where traders are made.
The stock of the day is KMD Brands. Now, the apparel retailer is experiencing a slower than expected start to the key winter period. So this is Kathmandu, it's Rip Curl, think of those names. Sales in the first 3 weeks of the key discount trading period were down 11.5% and below the second half trend. The owner of Kathmandu, KMD Brands, said sales are in line with the second half trend in Australia. However, New Zealand trade remains challenging. The retailer has 6 weeks of peak Kathmandu winter trade and Rip Curl Northern Hemisphere summer trade still to go. So let's see what the news has done to its share price, and it's down by 2%. So as we all know, pretty sensitive part of the market to the interest rate cycle. Let's get a view on KMD, and we'll start with you, Luke Winchester from Merriweather. Just too soon to get into these retailers?
Look, as far as, is it time to look at Kathmandu? Let's talk about retail in general as well. There's been City Chic and Mosaic Brands out today as well. I've heard it being said that one of the things to look for as a more qualitative factor for something like this is sort of what Kathmandu's done today, where you have a major downgrade. I mean, 50 million EBITDA is their guide. Consensus before this was for 140 million. Now, market's obviously been ahead of the downgrade. That chart there says it all. The market has been predicting this for some time. But as you flashed up before, we're looking at a stock down 2%. It's just downgraded its guidance by 60. That's the sort of factor where if you're the more brave investor, it's usually a sign that this is maybe as far as the beatdown goes. The only thing that gives me pause for thought on that, though, Nadine, is the paragraph in this update where they talk about their financial covenants. It's always a spooky word whenever you hear a business talk about banking debt and covenants. They've said they've had relief from their bankers over the next 3 testing periods. Not a good sign. We've got 130 mil debt here on this balance sheet. That's a fair whack of debt for a business this size, particularly that earnings base contracting as well. And when you hear about covenants being tested, of course, you start to think about recapitalisation and things like that. So, look, I'm not brave enough to come and say this is the time to be buying Kathmandu or retail stocks, but I did find it interesting. You've got this big, massive downgrade on one end, but the share price reaction quite muted because the market's obviously factored a lot of that in already. So, interesting watch list for me. Let's say hold for the program. But I thought I'd just raise a few things there that I thought were quite interesting to see.
Thanks. Thank you. Andrew, any reason to own KMD Brands?
I mean, retail is so tough, and my inner value investor is often tempted when you look at some of the multiples that these kinds of companies from time to time offer. My personal experience, they tend to be more often than not value traps. And the reality is it's just a brutally tough business to be in. Let me give you some stats here. We'll pan out a bit. This is a company whose group revenues were at 400 odd million, just shy of back in 2015. They're over $1 billion in the last full financial year. And that's sort of compounded out at about 13% per annum. What's wrong with that? Nothing's wrong with that. The trouble is, however, is that they have grown their share count by about 2.5-fold over the period, and the net margin has dropped from like almost 5%. It's almost been cut in half, in fact. So all of that together means the earnings on a per share basis have gone backwards. They took a real knock in COVID, obviously, but things just haven't really got better from there. And here's the insight I think that's important for retail investors to understand, particularly brick and mortar retail, is the operating leverage here is murderous when it goes against you. So they have something like 55% gross margins, and their fixed costs are such, the shops themselves, all of that kind of stuff. You can't get rid of that too quickly. So if you want to do a little bit of maths here, you could see EBITDA, operating profit, cut in half with only a 12% drop in revenue. In other words, it doesn't take much for things to really fall away. Now, that does work again in your favor on the other side. If sales start to lift up again, that you start getting a pretty healthy growth in profit. But as Luke said, you have to be fairly bold here, as the macro picture is not particularly fantastic. To me, it's just a bit like picking pennies up in front of a steamroller. I just think there are better opportunities there. And if you were particularly interested in this company, I would wait to see some evidence of the turnaround, and particularly, as Luke said, I would want to make sure that those debt covenants are not going to be. You don't want to see the company being rugged. Bankers are your friends until they're not.
Right. So this is an avoid for you, Andrew.
Yeah, it's an avoid.
Okay. All right, guys. Thanks for that. That's our stock of the day.
This program was brought to you by IG, Australia's #1 CFD provider. Trade over 17,000 markets with extended hours on key US shares and competitive spreads. All on an award-winning platform. IG, where traders are made.